Welcome to Beavers Wealth Management's July 2025 edition of Let's Talk Markets. Our goal remains clear: to educate, inform, and empower the families and businesses we serve. So if you find today's discussion valuable, please feel free to share it with those who might benefit from it. And we've got a lot to talk about today, but let's start with something that I think we can all relate to. What's the price of your July 4th cookout that we just had a few weeks ago? So here on Let's Talk Markets, we often discuss big economic topics like inflation and CPI data and market trends, which we're certainly going to do that today. But sometimes these abstract numbers and charts, they don't fully capture the real world impact that we all feel every day. And so with Independence Day just behind us, I thought it'd be kind of interesting and pretty fun to look at something that I think we can all relate to. And that's the cost of a July 4th cookout. So let's take a look at this chart. Now, according to the American Farm Bureau Federation, hosting a barbecue for 10 people this year would set you back about $70.92. First of all, when I heard that number, I'm thinking that probably is not Texas barbecues, because I don't think brisket was involved there, because you can't do that for $70.92. But that is actually down about 30 cents from last year, but still making it the second most expensive year since this tracking began back in 2013. Now, as always, the details, that's what matters. And while some items like pork chops and hamburger buns and chips, they've actually gotten a bit cheaper, others like beef and potato salad and canned pork and beans, they've actually gone up notably. So why the mixed grill of prices? Well, fewer cattle for processing, tariffs driving up some canned good costs, and continued pressure on farming costs. So interestingly, farmers see only about 15% of what you spend at the store, despite facing rising expenses themselves. Kind of makes you realize why they like the farm to market type of deals. 15 cents on the dollar is all that the farmers are seeing. I was blown away by that number. So what's the bottom line? Behind every data point we discuss, there's a real world story that affects all of us in both big and small ways, even in something as simple as hosting your backyard barbecue. And that's why it's so important to keep perspective, because even in an inflationary environment, some things like your July 4th cookout have actually gotten a bit cheaper than last year. Okay, on to one of my favorite parts of this, Ryan's market fact. And he dubbed this market fact today, and he called it, "There is no impossible in markets." On April 8th of this year, the S&P 500 was off to one of its worst starts to a year in history. It was down 15% on the year. And you can see on this first chart on the right, the start of 2025, it ranked as the fourth worst in the S&P 500's history. But after one of the most impressive comebacks ever, the S&P surged 22% over the past 12 weeks. It's now up more than 6% for the year. And so if you look at the second chart on the left, you'll see that it's currently performing above the historical average for the first 6 months of the year. I mean, a few months ago, that would have seemed impossible. But there is no impossible in markets. Thanks, Ryan. All right. Now, as we typically do, let's take a look at what the markets have done over the course of this last year. And so we'll look at a few data points here. I always like to see what are the three top performing sectors of the market. And we've actually had a bit of a change. Industrial still leads the way at 14% for the year. Utility is right behind it at 10%. But technology has actually crept back up into the top three. It was in the bottom three, now in the top three, up 9.8%. Thank you, NVIDIA. If you look at the bottom three S&P 500 sectors, consumer discretionary down 2% for the year, healthcare down about 1%, and real estate, which had been getting beat up pretty good, is still on the bottom three, but up about 4% for the year. Other things, Fed funds still at 4.5%. Unemployment has now ticked up to 4.1%. And then looking at GDP for the first quarter, which we had talked about last time, actually down about 0.5% for the first quarter of 2025. All right, so now that we sit here kind of mid-year, I thought it'd be important to kind of do a economic checkup, right? So where we stand and then think about what's ahead in the second half. And so we are now officially done to kind of take a look and pause. Let's catch our breath and let's reflect. What's happened in the markets so far this year? Man, we got a lot to cover. But what more importantly is on the horizon? So let's start with January to June, the first half of 2025. So the first 6 months, man, they were anything but quiet, right? Markets started strong, then saw significant volatility in April, sparked by the tariff-related tensions. And at one point, the market swung dramatically, with the volatility index, also called the VIX, briefly surging to extreme territory, indicating heightened investor anxiety. But as the tariff negotiations improved, like we've discussed, markets bounced back impressively. And by the end of June, major indices posted healthy gains. Now, the S&P 500 and the NASDAQ both closed up approximately 5 to 6%, recovering strongly from earlier declines. And the Dow Jones, it managed a respectable gain of around 4%, proving resilient amid trade uncertainty. Man, despite the roller coaster of markets that we've seen, the underlying economic data, it still remains robust. Employment growth stayed healthy, with the economy adding an average of about 175,000 new jobs each month, continuing a remarkable streak that now stretches back over 4 years. What about on the inflation front? Well, we've seen moderation. The Consumer Price Index, or CPI, which you all hear about, has actually cooled significantly from last year's highs, currently hovering around 2.4%. Now that's down from nearly 4% just a year ago. Remember, that still means that things are increasing at prices of 2.4% growth rate, but they're increasing at a slower pace than what we've seen. Yet, even with these solid fundamentals, political and trade tensions cast a long shadow over market sentiment, occasionally spooking investors into believing a recession was imminent, right? At one point earlier this year, the recession probability soared near 90%. But as negotiations with major trading partners, including a promising new agreement with China, progressed, these recession fears have eased substantially, dropping to around 30% now as we enter to the second half of the year. So what's the takeaway from the first 6 months of 2025? So despite the headlines and the volatility, the economy demonstrated impressive resilience. And this first half reminds us again why sticking to fundamentals, not headlines, is so crucial. Okay, so that was the first half of 2025. Now, let's talk about what we think is coming in the second half. What's our outlook from July to December and beyond? So as we look forward, the path ahead, it appears cautiously optimistic, but still contains challenges that I want to note here. First of all, inflation and Federal Reserve policy. The Fed's current stance suggests cautious optimism. Recent discussions from their June meeting indicated that they're leaning towards 2 potential rate cuts by the end of the year, totaling around 50 basis points or 0.5%. And this would likely place interest rates in the range of 3.75 to 4%. And the Fed's message, it remains clear. It's while rate cuts may be coming, rates are expected to stay elevated longer than many investors initially expected. Who does that sound like? Sounds like Beavers Wealth Management over the course of the last year on our Let's Talk Markets. We thought that we'd be in a higher interest rate environment for longer, and that's exactly what we're starting to see even the Fed expecting. Now, inflation, while controlled, it could see pressures building from the ongoing tariff environment that we're in right now, nudging year-end CPI slightly upward likely settling on what we believe will be around 3%. The most recent report showed an uptick from 2.4% year over year in May to 2.7% year over year in June. So that was an increase. And we've spent a lot of time discussing the mathematics behind these numbers in our May edition of Let's Talk Markets. So make sure to go back and you can watch on YouTube if you're curious to learn how that inflation number is calculated. It's all there for you in our Let's Talk Markets. All right, let's talk about the second thing, growth and recession risks. Economic growth is expected to be moderate, with GDP growth estimates hovering around 1.6% for 2025. Now that's below historical averages, signaling slower but still positive growth ahead. While recession probabilities, they had dropped significantly, analysts across Wall Street, they still note a lingering risk. Approximately 20 to 25% believe that there's a mild recession in the next 12 months. And this largely hinges on how the tariff situation evolves. Now, the odds of a 2025 U.S. recession on Polymarket have moved from 66% down to 22% over the past 2 months. And this really further strengthens the Fed's case for remaining on hold, waiting to see if any inflationary pressures from the new tariffs start to build. All right, so that's number two. What's the third thing? Well, corporate earnings and kind of market sentiment going into this second half of the year. Corporate earnings, they've been encouraging, I have to say. Analysts recently increased S&P 500 earnings expectations to around $265 per share for 2025, translating into about 6% growth. Now, that's not explosive, I realize that, but it reflects steady corporate health even amidst all of the challenges that we have going on. And valuations, they've actually risen, making markets slightly expensive by historical standards, no doubt. But therefore, you have to have careful selection and diversification more than ever. It's critical. Fourth point, geopolitical and policy considerations. Tariff policies remain the central uncertainty. Current trade agreements suggest tariff rates stabilizing around 13 to 15%. That's significantly higher than historical norms of around 2 to 3%. While investors have largely priced these into current valuations, policy shifts could still trigger volatility. Okay, so what's the bottom line, right? At Beavers Wealth Management, we always want to bring it to the bottom line. What does this mean for investors? As we step into the second half of 2025, the message is going to be clear. Volatility is likely here to stay. It's influenced by ongoing trade talks, shifting political dynamics, and central bank decisions. But the fundamentals, they remain strong, with robust employment, moderate inflation, and steady earnings growth. Most importantly, these market swings remind us why disciplined, diversified investing, not short-term reaction, remains our best approach. And so we will continue closely monitoring these developments as we continue into the second half of this year. Okay, now our final point today, I want to talk a little bit about historical asset class performance. And so we've covered a lot already, right? From cookouts and inflation to market updates, but let's wrap things up with something that I think is kind of fun and insightful. Take a look at this chart, detailing major asset class returns since 2011, updated through June 20th, 2025. And so what's the story so far in 2025? You can see it. This year, gold is the standout performer, up 28.1% year to date. While U.S. small cap stocks, they've actually lagged behind. They're down 3.5%. The beauty of this chart actually lies in what it reveals about investing over time. So what are some of those things? Well, looking at this chart, you can kind of see gold's resurgence. After a few quiet years, gold has actually surged to become the best performing asset class of 2025, emphasizing its role as a safe haven during uncertain economic periods. The other thing that I can see from here is consistency. It counts. Notice U.S. large caps right? It says SPY here, and the NASDAQ 100, QQQ. Both have consistently generated strong positive returns, averaging about 10 and 17% annually, respectively, since 2011. Now, consistency in performance, it's often key to long-term wealth building. The other thing to see here is rotation. It's inevitable. No single asset class consistently stays on top, as you can see from this graph, right? Commodities, the best performing asset class in 2022, they have struggled significantly in recent years. And similarly, long duration bonds, they've swung widely between leading and then lagging, highlighting the risks of chasing performance. The other thing is caution, it does pay off sometimes. While conservative assets like US cash, which here you can see is BIL, and preferred stocks, PFF, they've rarely topped the charts. They've provided stability during volatile periods in the market. And it's an important reminder of why diversified portfolios typically include what I consider some boring assets. Also, the other thing is a balanced approach, it does win. Over the long run, investors who stay diversified across multiple asset classes, not just chasing winners, achieve consistent growth without the anxiety of extreme volatility. And so what can we learn from this chart? Asset class leadership is always changing. As fun as it is to track the leaderboard, this chart is a good example of why diversification, discipline, and staying invested for the long haul remains the smartest strategies for investors. Now, as we've seen recently, market volatility can create significant uncertainty. And the people you care about may be feeling unsettled about their financial future. And so if you have a friend, family member, or colleague who could benefit from a trusted second set of eyes on their investments, now is the perfect time to introduce them to our second opinion service. And so we created this service so that anyone can come to us with their current investments, their financial plan, or whatever strategy they have and gain a new kind of fresh perspective on their investments and plan, ensuring their investments align with their unique goals and provide the reassurance that they're on the right track. And so if someone you know could benefit from this clarity, we encourage you to reach out to us anytime. We would be honored to help. Okay, that's all I got for us today. We're so grateful that you joined us, and we encourage you, share this content with anyone that you might find that might find it valuable. And we have all of the replays now on of Let's Talk Markets. They're posted on the new YouTube page. I hope you've checked it out. A lot of great content there. And then the video podcast format is still on Spotify for those of you who are using Spotify. YouTube and Spotify, they're also home to episodes of our podcast Between the Bears and the Bulls. We've been releasing new episodes every month of that. And honestly, if you have any suggestions on what you'd like to see from us, please let us know. We want to make sure the content we put out is valuable for you. That's why we're doing it. Oh, and one last thing. Did y'all hear what the hot dog said to the hamburger? You're on a roll, buddy. We'll see you next month for our August edition of Let's Talk Markets. And don't forget, leave it to Beavers.